Welcome back to XRP On Moon, the channel where we uncover the biggest opportunities, hidden signals, and explosive developments in the XRP ecosystem before the mainstream catches on. Today's topic is one that's creating serious waves across the financial world, and it might completely change the way you look at XRP forever. Experts are now predicting a potential $1,000 XRP, and even more shocking, there is growing discussion that banks may soon be pushed, by pure economic pressure, into using XRP as part of their core systems. At first, this might sound like another exaggerated headline, but when you start digging deeper into what's happening behind the scenes in global finance, a very different and much more compelling reality begins to unfold. Right now, the global banking system is facing a silent crisis. Cross-border payments, the backbone of international finance, are still relying on outdated systems that were designed decades ago. These systems are slow, expensive, and incredibly inefficient in a world that now demands instant transactions. Every day, trillions of dollars move across borders, but the process can take days to settle, with multiple intermediaries taking fees along the way. This isn't just a minor inconvenience. It's a massive structural problem that costs institutions billions annually and locks up huge amounts of capital that could otherwise be used more productively. And this is exactly where XRP enters the picture. Not as just another cryptocurrency, but as a purpose-built solution designed to fix these deep-rooted inefficiencies. What makes XRP stand out is its ability to act as a bridge currency through on-demand liquidity, eliminating the need for banks to hold pre-funded accounts in different countries. Instead of locking up capital across the globe, institutions can use XRP to move value instantly, settling transactions in seconds rather than days. Now think about the scale of this transformation. If even a portion of global banks begin to adopt this model, the demand for XRP wouldn't just increase. It could surge at a level that most retail investors are not prepared for. This is why some experts are no longer treating XRP as a speculative asset, but as a potential cornerstone of future financial infrastructure. And here's where the idea of banks being forced to use XRP starts to make sense. Not through regulation, but through competition. Imagine one major financial institution successfully implementing XRP and cutting its transaction costs dramatically while speeding up settlement times. Other banks would immediately feel the pressure. In a competitive industry, no institution can afford to fall behind. If XRP provides a clear advantage, adoption becomes less of a choice and more of a necessity. This kind of shift doesn't happen overnight, but once it reaches a tipping point, it can accelerate incredibly fast, catching the majority of the market off guard. Now let's address the number that's grabbing everyone's attention, the $1,000 XRP prediction. On the surface, it seems unrealistic, and that's exactly why so many people dismiss it without fully analyzing the underlying assumptions. But these projections aren't based on today's market conditions. They're based on a future scenario where XRP is deeply integrated into the global financial system, facilitating massive volumes of liquidity every single day. In that kind of environment, price isn't just driven by speculation, it's driven by real-world demand at an institutional scale. And when demand reaches that level, traditional valuation models begin to break down. What most people fail to realize is that financial revolutions often start quietly. While retail investors focus on short-term price movements, institutions are planning years ahead, testing systems, forming partnerships, and preparing for large-scale implementation. By the time the shift becomes visible to the public, a significant portion of the groundwork is already complete. This is why some experts believe that when XRP's true utility finally activates, the price movement could be sudden and aggressive, leaving very little time for latecomers to react. So the real question you need to ask yourself is not whether $1,000 XRP sounds crazy today, but what happens if the global financial system begins to rely on XRP as a core liquidity tool? Because if that scenario starts to play out, even partially, the implications could be far bigger than most people currently imagine. It becomes increasingly important to understand how the transition toward XRP adoption in the banking sector could realistically unfold, because this is where the entire forced adoption narrative starts to gain real weight. It is not about a sudden global mandate or a single announcement that changes everything overnight. Instead, it is about a gradual but irreversible shift driven by efficiency, competition, and survival in an increasingly digital financial world. When experts talk about banks being forced into XRP, they are really describing a situation where avoiding XRP becomes more expensive and less competitive than adopting it. To understand this, you need to look at the economics of cross-border payments. Today, banks rely heavily on correspondent banking relationships, pre-funded accounts, and multiple intermediaries to move money across borders. Every step in this chain adds cost, delay, and operational complexity. These inefficiencies are not minor. They scale into billions of dollars annually across the global financial system. Now imagine a scenario where XRP removes much of this friction by enabling near-instant settlement and eliminating the need for pre-funded liquidity pools. The financial incentive alone becomes extremely powerful. Banks are not driven by ideology, they are driven by efficiency and profit margins. If a technology consistently reduces costs and improves liquidity management, it naturally becomes attractive. This is where Ripple's on-demand liquidity model becomes central to the discussion. Instead of locking capital in various countries just to enable transactions, institutions can use XRP as a bridge asset, converting value in real time. This frees up liquidity that was previously trapped in dormant accounts. For large financial institutions, this is not a small improvement. It is a structural upgrade in how capital is managed. When billions of dollars can be unlocked and redeployed more efficiently, the incentive to adopt such a system becomes extremely strong. And once a few major players adopt it successfully, the rest of the market begins to feel pressure to follow. Now, consider the competitive landscape. Banking is not a static industry. It is one of the most competitive and tightly regulated sectors in the world. If one institution gains a significant advantage in transaction speed and cost reduction, others cannot simply ignore it. They either adapt or risk losing market share over time. This is where the forced aspect becomes more realistic, not because of external pressure from regulators, but because of internal pressure from competition. Once XRP proves its effectiveness at scale, it stops being an experimental tool and starts becoming a strategic necessity. Another layer that often gets overlooked is regulatory direction. While regulators may not explicitly promote XRP, they are increasingly pushing for faster settlement systems, improved transparency, and reduced systemic risk in financial operations. Blockchain-based solutions align with many of these goals, even if indirectly. As regulatory frameworks become clearer and more accommodating toward digital settlement infrastructure, banks will find it easier to integrate systems like XRP without fear of compliance uncertainty. This removes one of the biggest barriers to adoption. At the same time, we cannot ignore the role of network effects. Financial systems become more powerful as more participants join them. If multiple banks and payment providers begin using XRP for liquidity, the system becomes more efficient, deeper, and more liquid. This creates a feedback loop. The more it is used, the more useful it becomes. Eventually, staying outside of that network could mean operating at a disadvantage compared to competitors who are already benefiting from faster settlement and lower costs. When you combine all of these factors, cost reduction, liquidity efficiency, competitive pressure, regulatory alignment, and network effects, you begin to see why some experts believe adoption could accelerate faster than expected. It is not a single trigger event, but a chain reaction that builds momentum over time. And once that momentum reaches a certain threshold, change can happen rapidly, almost suddenly from the outside perspective. This is also where the conversation naturally shifts toward price impact. Because if XRP begins to play a meaningful role in global liquidity infrastructure, the demand profile changes completely. It is no longer driven by retail speculation alone, but by institutional usage at scale. We move deeper into this analysis. The focus naturally shifts toward one of the most critical elements in the entire XRP discussion: supply and demand at a global scale. This is where most debates around extreme price predictions like $1,000 XRP either gain strength or fall apart, depending on how realistically the underlying mechanics are understood. To properly evaluate this, you have to step away from short-term market thinking and instead look at how XRP would function if it became deeply embedded in global financial infrastructure. At its core, XRP has a fixed maximum supply of 100 billion tokens, which immediately creates a hard ceiling on issuance. Unlike traditional financial systems where central banks can expand supply, XRP operates within a predetermined limit. However, what truly matters in this discussion is not just the total supply, but the effective circulating supply available for real-time liquidity. A significant portion of XRP is locked in escrow, released gradually over time, while another portion is held long-term by investors, institutions, and ecosystem participants who are unlikely to actively trade large volumes at low prices. This creates a situation where the actively available supply in the market is much smaller than the headline number suggests. Now introduce institutional demand into this equation, and the dynamics begin to shift dramatically. If banks and financial institutions start using XRP as a bridge currency for cross-border settlements, they will not be engaged engaging in small-scale transactions. They will be moving large volumes of value continuously across global corridors. Even if XRP is reused efficiently due to its fast settlement speed, the system still requires sufficient liquidity depth to handle peak transaction flows without slippage or instability. This means institutions may need to hold significant XRP reserves, effectively removing more tokens from active circulation. As more institutions enter the system, this creates a compounding liquidity effect. The more XRP is required to support transaction volume, the more it becomes locked into operational use rather than speculative trading. This reduces available supply on exchanges while simultaneously increasing demand from real-world utility. In traditional market terms, this is a classic setup for upward price pressure, when supply becomes constrained and demand is structurally persistent rather than temporary. Another important factor often misunderstood is transaction velocity. XRP is designed for rapid settlement, which means the same units of XRP can be reused multiple times within a short period. Critics argue that this reduces the need for high valuation, but this view overlooks a key detail. Liquidity efficiency does not eliminate the need for depth and value. Large financial transfers still require a stable and sufficiently valuable bridge asset to ensure smooth execution. If transaction volumes scale globally, the system still needs enough liquidity value per unit to support large settlements without excessive volatility. On top of this structural demand, you also have to consider market psychology. Once XRP begins to be recognized not just as a crypto asset, but as a functioning piece of financial infrastructure, investor perception changes significantly. Retail participants often follow institutional confidence, and when narratives shift from speculation to utility, capital inflows tend to accelerate. This introduces a second layer of demand that sits on top of institutional usage, speculative and long-term investment demand driven by belief in future adoption. It is also important to recognize that valuation models in this context become far more complex than traditional crypto pricing frameworks. If XRP were ever to operate as a core liquidity layer in global finance, its value would be influenced not only by exchange trading activity, but by its role in enabling trillions of dollars in settlement flows. In such a scenario, even small inefficiencies or liquidity shortages could require a higher unit price to maintain system stability across high-volume corridors. This is why some analysts argue that extreme price targets like $1,000 should not be dismissed purely on circulating supply calculations alone. Instead, they are based on hypothetical scenarios where XRP transitions from a traded digital asset into a global liquidity utility. In that environment, demand is not driven by hype cycles, but by continuous institutional necessity, which changes the entire structure of valuation logic. And this brings us to a crucial turning point in the discussion. If supply constraints and institutional demand begin to align in the way many experts suggest, the next question becomes even more important. What real-world catalyst could trigger this level of adoption, and how quickly could such a shift realistically occur? As we continue, we now reach the most important layer of this entire discussion, the real-world catalysts that could actually trigger large-scale XRP adoption in the global financial system. Because while long-term theories about utility, liquidity, and institutional demand make the case interesting, markets don't move on theory alone. They move when specific events, pressures, or shifts force institutions to act faster than they intended. This is where the idea of XRP adoption transitioning from optional to necessary begins to take shape. One of the strongest potential catalysts is instability or inefficiency within the current cross-border payment infrastructure. The global financial system still relies heavily on correspondent banking networks, which are slow, fragmented, and dependent on multiple intermediaries. If these systems experience increasing strain, whether due to rising transaction volumes, geopolitical tensions, or liquidity bottlenecks, financial institutions will be pushed to seek faster and more resilient alternatives. In such a scenario, XRP's ability to settle value in seconds could shift from being a competitive advantage to an operational requirement. Another major driver could be regulatory clarity. For years, uncertainty around digital assets has slowed institutional participation. Banks and payment providers are highly risk-averse, and they cannot fully integrate new systems without clear legal frameworks. However, as global regulators move toward more structured crypto policies and digital asset frameworks, the barriers to adoption begin to fall. Once compliance becomes clearly defined, institutions no longer have to wait on the sidelines. They can begin integrating blockchain-based liquidity solutions with confidence. This is the kind of shift that doesn't just open doors, it unlocks entire sectors of financial innovation. Partnership expansion is another critical factor that cannot be ignored. Over time, as more financial institutions, remittance companies, and fintech platforms integrate XRP into their payment rails, the network effect becomes increasingly powerful. Each new participant doesn't just add usage, they add liquidity depth, transaction volume, and credibility to the system. This creates a cascading effect where early adopters benefit first, and late adopters are gradually pushed to join simply to remain competitive. In financial systems, once a new standard starts forming, resisting it becomes more expensive than adopting it. We also have to consider the broader global shift toward digital transformation. Central banks and governments worldwide are actively exploring digital currencies, tokenized assets, and real-time settlement systems. Even though these initiatives may not directly depend on XRP, they are reshaping the entire financial architecture in a way that is increasingly compatible with blockchain-based liquidity solutions. As infrastructure modernizes, assets like XRP become easier to integrate, not harder. This gradual alignment of traditional finance with digital rails is one of the most important background forces driving long-term adoption potential. Technological maturity also plays a role in accelerating this process. As XRP's underlying infrastructure continues to evolve, improving scalability, interoperability, and reliability, it becomes more attractive for institutional-grade usage. Financial institutions do not adopt technology based on hype. They adopt based on stability, performance, and long-term reliability. As these technical standards are met and proven in real-world conditions, confidence increases and adoption becomes more likely across larger segments of the financial sector. When you combine all of these catalysts, system inefficiencies, regulatory clarity, institutional partnerships, global digital transformation, and technological maturity, you begin to see a pattern. None of these factors alone guarantees rapid adoption, but together they create a reinforcing cycle of pressure and opportunity. Once this cycle reaches a tipping point, adoption does not progress slowly. It accelerates rapidly, often in ways that surprise even market participants who were watching closely. This is why some experts believe that XRP's potential growth phase may not resemble traditional market cycles. Instead of gradual expansion, it could resemble a compressed acceleration phase where adoption happens across multiple institutions in a relatively short period of time. And when that happens, market pricing often reacts faster than public understanding can catch up. At this stage of the discussion, the focus naturally shifts toward implications, what this means for investors, how risk should be understood, and why extreme price predictions must always be balanced against real-world uncertainty. It's important to bring everything together in a clear and grounded way. We've explored the idea of XRP potentially reaching extreme valuations like $1,000, the possibility of banks integrating or even being economically pressured into using XRP, and the structural changes happening across global finance that make these discussions more relevant than ever before. But now the key question becomes not just what could happen, but how all of this should actually be interpreted in the real world. When you combine all the previous points, liquidity efficiency, institutional adoption potential, supply constraints, network effects, and global financial modernization, you can see why XRP continues to attract serious attention from analysts and experts. The core value proposition is not based on hype, but on utility, faster settlement, reduced costs, and improved liquidity management across international payment corridors. If these advantages continue to prove themselves in real-world usage, then adoption is not just possible, it becomes strategically logical for financial institutions operating at global scale. However, even with all these strong theoretical foundations, it is crucial to remain realistic about how financial systems actually evolve. Global banking infrastructure does not change overnight. It moves through gradual integration, pilot programs, regulatory evaluation, and long-term testing before full-scale adoption ever occurs. Even when a technology is superior, adoption timelines can stretch across years or even decades due to compliance requirements, legacy systems, and risk management concerns. So while the long-term vision of XRP playing a major role in global liquidity is widely discussed, the path toward that outcome is neither guaranteed nor linear. The $1,000 XRP narrative in particular should be understood as a hypothetical scenario based on extreme assumptions about future demand, institutional usage, and global financial integration. It reflects a model where XRP becomes deeply embedded in the movement of large-scale capital across borders, potentially handling significant portions of global liquidity flows. In such a scenario, valuation frameworks based purely on today's retail trading metrics may no longer apply in the same way. But it is equally important to recognize that these are forward-looking projections, not certainties. Market reality is shaped by a wide range of unpredictable factors. Competing technologies may emerge, regulatory landscapes may shift in unexpected ways, and institutional priorities can change based on macroeconomic conditions. Even if XRP continues to expand its role in the financial ecosystem, the speed and scale of that expansion remain open variables. This is why serious analysis always separates potential from prediction. For investors, the most important takeaway is to focus on fundamentals rather than extreme price targets alone. Understanding what XRP is designed to do, facilitate efficient global liquidity, is far more important than anchoring expectations to any single price outcome. In rapidly evolving markets like cryptocurrency, narratives can shift quickly, and long-term success is usually tied to real-world utility rather than speculative projections. At the same time, it is essential to acknowledge the risks involved. Cryptocurrency markets are highly volatile, and prices can move sharply in both directions. External factors such as regulation, technological competition, macroeconomic conditions, and market sentiment can all significantly impact outcomes. No digital asset, including XRP, should ever be viewed as a guaranteed investment or a risk-free opportunity. To be clear, this content is for informational and educational purposes only and should not be considered financial advice. You should always conduct your own independent research before making any investment decisions and consider consulting with a qualified financial advisor. Investing in cryptocurrencies involves risk, including the potential loss of capital, and past performance does not guarantee future results. So while the idea of XRP being integrated into global banking systems and reaching extremely high valuations is an intriguing and widely discussed topic, it remains a long-term speculative scenario rather than a confirmed outcome. The real story is not about guaranteed prices. It is about ongoing technological evolution, institutional experimentation, and the gradual transformation of how global value moves across borders. And that is where the real opportunity and the real uncertainty both exist.